Welcome to the first of the PowerPoint presentations dealing with contributions. This one is dealing mostly with contribution strategies. The other presentations are dealing with some of the changes that have come in through from the ATO this year. Just be aware that contributions are received by superannuation funds from time to time to provide the retirement benefits for its members. The ATO has this year issued a ruling clarifying its position with respect to the receipt of contributions from a superannuation fund in the variety of forms. Contributions are received by superannuation funds in a number of forms, and these include: number one, tax deductible to the contributor and non-tax deductible to the contributor. Sometimes it's an exercise in reducing other taxes by making contributions, for example the capital gains tax retirement exemption. It's not the purpose of this presentation to explore the straightforward forms of contributions, otherwise we'd just run out of time and we'd be here for hours. So the areas that I won't be covering include employer contributions, employee and member contributions, TRIS contributions, employment termination payments, which are rolled over, although I have covered a little bit of that in another area. I won't be covering eligible spouse contributions nor government co-contributions. What I will be covering is contribution reserves, and that'll be mostly in this presentation. In the future presentations, the other files contain information on tax deferral contributions, in specie and in-house assets, borrowing and contributions. So just so you're aware, a contribution reserve, when a contribution is received into a self-managed super fund, it can be allocated immediately on the same date to the member's account, or it can be allocated to a reserve account. Contribution reserves are used to change the taxing point of the contribution from the date that it was banked to a future date. So it changes it from the date that it was received in the bank to a future date. It's put into a reserve account, then at a future date it's taken out of the reserve account and allocated directly to the member's account. Regulation 7.082 states that a superannuation contribution must be allocated to the member account within 28 days after the end of the month it is received. So a practical example: if a contribution is received on the 1st of May, then it must be allocated to the member's account by the 28th of June. Of course, the end of the financial year is a measurement point for contribution levels, and of course if we over-contribute, we have excess contributions tax, which is quite heavy and very steep and quite unpopular. And so we use contribution reserves in this way. Section 292 90.4 provides that a contribution allocated to a member from a contributions reserve is not counted in the year of allocation. There is a complication with this for member or non-concessional contributions in the paragraph. So we have some complications there. Fortunately, the tax office recognises the intent rather than the poor wording, and so they have provided their opinion stating that they will allow the use of the contribution reserve to prevent the incurring of excess contributions provided in 90-4, provided that's complied with, i.e. the contribution being allocated within 28 days from the end of the month. They've got no problems with it. So it's important to note that this is a strategy which we can utilise to avoid excess contributions tax, but it really only works to diminish excess contributions tax if that contribution that is counted, that would be used to exceed that level, is received in June. Let me give you an example. Mel is 51 years of age, has made the following member contributions over the past few years. In June 2007, I put in the maximum amount that year of $1 million. Wouldn't that be lovely, hey? And then in July 2007, I put in $450,000. I used the 3-year bring forward provision. 3 years at $150,000 a year comes to $450,000. Then, without seeking any advice, I contributed another $100,000 in June 2010. Now you may think, well, $100,000 is not exceeding the maximum contribution, but I've got a problem. Whoops. I've cleared the non-concessional cap. I've breached it as the bring forward period, the 3 years at $150,000 a year, does not expire until the 1st of July 2010. So what can I do to remedy the situation? Well, clearly, if my trustee allows it, the $100,000 deposited in June 2010 is allocated to the contribution reserve account and not Mel's member account. Then after the 1st of July and before the 28th of July, the contribution reserve then is allocated to Mel's member account. By so doing, for the year ended 30th of June 2010, I've avoided excess contributions and the excess contributions tax that would be levied against me. So in summary, this requires planning between your tax accountant, the self-managed fund administrator and the auditor. A very worthwhile planning device that is currently underutilised through ignorance, I believe. Just a tip though, even though we might by law be able to do this, if the trustee that you have does not allow it, then we can't use the provision account or the reserve account. Therefore, your deed must allow it, and be aware that as we've been updating most of the deeds in the last couple of years, the new deeds, of course, give you the right to use contribution reserve accounts. Thank you very much.